The American housing market isn't cooling. It's quietly imploding. And the U.S. economy 2025 narrative is masking a deeper U.S. recession crisis that's tightening its grip. Beneath the surface, a looming housing crash is forming as mortgage debt surges past $12.7 trillion, while affordability collapses to its lowest point since 1986. The average family earning $78,000 can now afford less than 18% of homes nationwide. For years, homeowners believed rising property values guaranteed financial security. But inflation has silently erased those gains. Home equity is no longer real wealth. It's leverage disguised as success. The dream of ownership has turned into a debt trap, and the system built on cheap credit is finally cracking. The illusion of prosperity has officially failed. Behind polished headlines about soft landings lies brutal math no economist can spin anymore. The cost of borrowing has exploded. The 30-year fixed mortgage rate, once 2.6% in 2021, now hovers around 7.8%, tripling the cost of homeownership in just 4 years. A $400,000 mortgage that required $1,600 a month in 2021 now drains nearly $2,900. That's not simple inflation. It's economic paralysis. Each month, millions of buyers are priced out before even applying, while sellers cling to unrealistic valuations no one can finance. The deeper fracture, however, isn't only interest rates, it's wages. The median household income has crawled from $70,800 to $78,000, a gain of barely 10%. Meanwhile, the median home price has surged from $329,000 to over $420,000, creating a 90% mismatch between income and housing costs. The average worker now needs 45% of gross income just to service a mortgage, the highest burden ever recorded. When debt-to-income ratios reach these levels, credit quality collapses. Banks tighten lending, approvals fall, and the cycle reinforces itself. This is no longer a functioning housing market. It's a leverage machine eating itself alive. For nearly 2 decades, cheap money fueled artificial demand, inflating property values far beyond real wages. Now the system is reversing, painfully, mathematically, inevitably. As rates rise, every percentage point removes millions of potential buyers. A 1% hike wipes out roughly 5 million qualified households. That's the silent culling behind the statistics. The fallout is already visible. Pending home sales have dropped 16% year over year. Mortgage applications have fallen to a 28-year low, and builder sentiment has plunged to crisis levels. Even the once unstoppable Sunbelt markets, Florida, Texas, Arizona, are bleeding inventory faster than during the 2008 collapse. Wages can't keep up, prices won't fall fast enough, and the middle class is trapped between soaring rates and stagnant paychecks. This isn't a correction. It's the mechanical failure of an economy built on unaffordable dreams. The math no longer works, and when the math fails, everything built on top of it follows. The next phase isn't speculation, it's collapse. And it's already spreading into the core of the financial system. The collapse isn't just coming from overstretched families. It's being engineered from the top of the financial pyramid. For years, Wall Street turned homes into tradable assets, buying thousands of properties with borrowed money and renting them back to the same people priced out of ownership. By 2025, institutional investors control nearly 1 in every 5 single-family homes in America, financed through a maze of credit lines, synthetic bonds, and opaque rent-backed securities. The same architecture that fueled the 2008 mortgage bubble has returned. Only now it's larger, hidden, and far more leveraged. When mortgage rates surged, these corporations didn't stop borrowing. They simply shifted their debt into private credit funds. As yields climbed, the value of those bonds collapsed, triggering a silent chain reaction. Margin calls, forced liquidations, and panic selling followed, disguised as routine price adjustments. Unlike the retail chaos of 2008, this is a corporate-level implosion happening behind closed doors. REITs and hedge funds are unloading properties at discounts of 15% to 25%, not to help buyers, but to survive crushing balance sheet pressure. Every discounted sale adds more supply to an already drowning market. This shadow bubble feeds on the same disease that infected the broader economy: leverage without productivity. Institutional landlords refinanced at 3% rates in 2021, but those loans are now resetting above 7%. That means monthly debt service on a billion-dollar portfolio has doubled. The math doesn't work anymore, and neither do the spreadsheets that once justified sky-high valuations. This isn't a correction. It's forced deleveraging on an industrial scale. And here's the silent killer. As these giants dump assets, small investors who bought at the peak are trapped. Their equity gains vanish overnight as comparable prices fall. Even banks holding these securities are facing mark-to-market losses, tightening liquidity even further. The illusion of safety, of institutional stability, is gone. Everything ties back to the fractures already visible: soaring rates, stagnant wages, collapsing affordability. Wall Street merely repackaged the risk into a new form and labeled it innovation. Now, the very instruments that created fake prosperity are detonating in sequence. The crash has already begun, not with sensational headlines, but with quiet balance sheet implosions that will soon materialize as foreclosures, job losses, and disappearing wealth. The unraveling is no longer theoretical. It's measurable, visible, and accelerating beneath the surface of official optimism. The housing market's bloodstream is drying up. New home sales have plunged 14% year over year. Existing sales are down 0.7%. Active listings have exploded 29%, flooding a market with buyers who no longer exist. Homes that once disappeared in 72 hours now sit unsold for an average of 53 days. That's not a cool down, it's paralysis. The velocity of money in housing, the lifeblood of credit creation, has collapsed. The pattern is nationwide. In Florida, condo inventories have doubled. In Austin, prices are down 18%. In Seattle, 13%. In Phoenix, 15%. Builders are slashing prices not to compete, but to survive. Their confidence index sits at 33, a psychological cliff where anything under 50 signals contraction. Nearly 4 in 10 builders are offering direct price cuts, some exceeding 20%. Yet even those incentives can't spark demand because affordability has already been destroyed by soaring debt costs. When the average monthly mortgage payment has surged 80% since 2020, price cuts don't matter. The real shock isn't falling prices, it's evaporating liquidity. Mortgage originations are down 55% from their 2021 peak, the steepest collapse since records began. Realtors, appraisers, inspectors, and lenders are watching their business volumes fall off a cliff. The credit arteries that once pumped trillions into local economies have frozen. Behind every unsold home lie frozen commissions, unpaid contractors, delayed permits, and canceled developments. It's not just housing that's slowing, it's the entire ecosystem built around it. Yet the narrative of resilience continues because the crash is slow, uneven, and largely disguised. It doesn't look like the headlines of 2008. It feels like suffocation. Transaction by transaction, city by city, sellers are trapped by high rates, buyers by high prices, and lenders by rising delinquencies. The result is a nationwide stalemate where time itself becomes the enemy. Each month, inventory rises, credit tightens, and desperation grows quieter but deadlier. The collapse isn't an event waiting to happen. It's a process already in motion, silently rewriting the American balance sheet one empty house at a time. As the market freezes, households are reaching their breaking point. For the first time in modern history, Americans are defaulting on their homes before their cars. Early-stage mortgage delinquencies have surged 28% year over year, outpacing every other credit category. The average mortgage balance has climbed to a record $267,700, while household debt has surpassed $18.6 trillion, exceeding the size of the entire U.S. economy. This isn't consumer resilience. It's a slow-motion credit failure camouflaged by denial. Disposable income has been swallowed by survival costs. Energy bills up 22%, property insurance up 38%, and real estate taxes rising across nearly every state. The median family now spends 43% of net income on housing-related expenses. The financial buffer is gone. The national savings rate sits at just 3.8%, one of the lowest in half a century, while credit card debt has crossed $1.33 trillion, another record high. The American household is leveraged to extinction. But what's happening beneath the statistics is even darker. As wages stagnate, the average family is funding everyday essentials with revolving debt, effectively using credit cards to subsidize mortgage payments. Auto delinquencies are rising, rents are climbing, and personal loans have spiked more than 20% since 2023. The entire middle class is now surviving on borrowed dollars and borrowed time. Inflation has quietly restructured the economy, turning ownership into a luxury and stability into a privilege. This erosion of household solvency is directly feeding the broader housing collapse. When millions can no longer meet payments, foreclosures accelerate, pressuring local markets already saturated with unsold homes. Each missed payment becomes another ripple in a system teetering on the edge of liquidity exhaustion. Consumer debt defaults will merge with corporate losses, recreating the same feedback loop that detonated 2008, only deeper. Because this time there is no safety cushion, no savings buffer, and no cheap money to reinflate the system. The narrative of temporary inflation has disintegrated. Americans aren't just running out of cash, they're running out of options. What began as a housing correction is transforming into a nationwide solvency crisis, one mortgage statement at a time. And when the consumer breaks, the economy follows. The American dream cannot survive on borrowed breath forever. The collapse of housing isn't an isolated malfunction. It's the detonation point for the entire U.S. economy. Every new home once triggered a chain of production across hundreds of industries, from concrete and lumber to appliances and transport. That chain is now breaking in real time. Residential construction spending has fallen 12% year over year, the steepest drop since the pandemic. Furniture orders have collapsed 24%. Appliance sales are down 17%. And home improvement retail, once booming, is contracting for the first time in a decade. Denial delays panic, but it also deepens collapse. The longer people refuse to accept falling values, the more inventory clogs the system, the faster liquidity disappears, and the sharper the eventual correction becomes. Optimism has turned toxic. What once fueled the boom now guarantees a harder crash. This isn't just a financial downturn, it's a psychological unmasking of a nation addicted to the illusion of endless growth. And that illusion is dying in real time. The Federal Reserve is trapped inside the very fire it created. Between 2020 and 2022, it printed over $6 trillion, driving real yields into negative territory and inflating the largest asset bubble in modern history. That flood of cheap money ignited a housing frenzy. 0% rates, bidding wars, and homes selling in hours above asking. But when inflation hit 9.1%, the same institution that fueled the boom became its executioner. In less than 2 years, the Fed unleashed the fastest rate hike cycle in 4 decades, detonating the foundation it had built. The result is an economy in mathematical contradiction. High rates were supposed to tame inflation, yet shelter costs, the very metric rate hikes were meant to cool, remain elevated, driven by frozen supply and homeowners locked into 2.5% mortgages who refuse to sell. New buyers can't qualify, and construction financing has evaporated. The policy meant to restore balance has instead paralyzed movement. Every additional rate increase multiplies defaults, suppresses credit, and erodes tax revenues. The medicine is now more lethal than the disease. Liquidity has drained from every sector tied to real estate. The M2 money supply has contracted by over $1 trillion, a deflationary shock not seen since the Great Depression. Regional banks overexposed to residential and commercial property are tightening standards to survival mode. The credit impulse, the real engine of economic growth, has flatlined. What was once an everything bubble is becoming an everything freeze. This is the paradox of modern monetary engineering. Print to inflate, hike to deflate, and trigger collapse in both directions. The Fed cannot win because its toolkit is outdated in a debt-soaked system that survives only on perpetual liquidity. Cut rates and inflation reignites. Hold rates and defaults surge. There is no exit, only a choice between two forms of economic decay. The illusion of control is ending. The same central bank that promised a soft landing has cornered the nation between recession and insolvency. What we're witnessing isn't policy. It's damage control disguised as strategy. And as this tightening cycle drags on, the line between correction and catastrophe thins by the day. While ordinary Americans cling to optimism, the elites have already begun retreating. Hedge funds, private equity firms, and real estate trusts are quietly liquidating positions that once symbolized invincibility. Over the last 3 quarters, institutional property sales have surged 62%, while bulk purchases have fallen to their lowest level since 2012. These aren't random shifts. They're strategic evacuations. The so-called smart money knows the credit cycle is broken. The same entities that inflated this bubble with cheap leverage are now dismantling it brick by brick. And before the public fully realizes what's happening, the banks are following the same script. Regional lenders heavily exposed to real estate are slashing loan issuance by nearly 30%, while major financial institutions have frozen new jumbo lending altogether. Balance sheet fragility is spreading quietly, with mark-to-market losses on commercial mortgage portfolios estimated above $120 billion. Yet most of it remains undisclosed to prevent mass withdrawals. Behind every press release about stability lies another hidden capital call, another margin breach, another silent bailout. Even publicly traded home builders are showing tremors, with stock prices diverging from broader markets, a clear signal that insiders anticipate a multi-year contraction. Real estate investment trusts are offloading entire rental portfolios to private buyers at 15% to 25% discounts just to cover maturing debt. These sales provide short-term liquidity but accelerate the downward spiral of valuations. The illusion of institutional strength is cracking under its own weight. At the macro level, liquidity corridors that once absorbed risk have reversed. Repo markets, used by banks for overnight funding, are tightening as collateral quality deteriorates. Capital that once flowed into real estate is fleeing to treasuries and commodities. What remains is an over-leveraged housing complex suffocating without its financial oxygen supply. This exodus is the final confirmation that the system is entering phase 2. Withdrawal. The elites are not predicting collapse. They are engineering their escape from it. When the top 1% unloads before the broader public senses danger, the outcome is already written. What began as a controlled correction is now morphing into a liquidity vacuum where everything built on borrowed confidence will meet the gravity of real value. The next stage won't arrive as a sudden crash. It will come as exhaustion. Prices won't fall all at once. They will bleed slowly, month after month, until denial turns into surrender. National home values are already down in a third of metro areas, and independent analysts project corrections of 35% to 70% in overheated markets. The median price-to-income ratio, once 4-to-1, has stretched beyond 7-to-1, a level no economy has ever sustained without imploding. This correction isn't speculation. It's mathematics enforcing gravity. The timeline is already visible. 2025 marks the liquidity freeze, 2026 brings credit unraveling, and by 2027, delinquency waves will mature into full-scale foreclosures. States with high investor concentration, Florida, Texas, Nevada, Arizona, will see entire subdivisions listed simultaneously as institutional portfolios unwind. When that happens, prices won't decline. They will collapse as supply surges while credit vanishes. History shows that for every 1% rise in delinquencies, home prices fall an average of 5%. We're already past 2%. Property tax revenues will contract, hammering local governments. City budgets dependent on inflated assessments will face deficits, triggering layoffs, reduced services, and further migration. The chain reaction will ripple through construction, retail, and manufacturing, deepening the slowdown into a synchronized recession. Even if the Federal Reserve reverses course, the lag in monetary transmission ensures relief arrives too late. Temporary rate cuts can't restore solvency once confidence dies. Investors are already pricing the future. Real estate ETFs trade at a 30% discount to net asset value, signaling institutional expectations of deep write-downs. Foreclosure filings are up 28% year over year, the early pulse of systemic failure. Yet the public waits for headlines declaring a crash, unaware that the crash is already happening. The housing market doesn't explode. It erodes, leaving only debt. Every unsold home, every underwater mortgage, every frozen loan is part of a silent liquidation of the middle class. The illusion of ownership is fading, replaced by the cold arithmetic of overvaluation and insolvency. The reset isn't coming. It has begun. Its scale will define the decade ahead. What's unfolding isn't a market correction. It's the dismantling of an illusion that held America together for half a century. The dream of homeownership has become the nightmare of debt servitude. Every statistic now whispers the same truth. The bubble didn't burst suddenly. It decayed silently while everyone watched. The middle class is being erased, not by disaster but by design, through inflation, leverage, and policies that traded stability for speculation. The American home, once a symbol of freedom, has become an anchor, dragging families underwater. And as the final layer of denial fades, the reckoning won't be purely financial, it will be social. When millions realize the system was never built to protect them, trust will collapse faster than prices ever could. The greatest housing crash of our lifetime isn't coming. It's already here, and it's far from over.